Welcome back to Part B of Topic 8 lecture. Here, we will discuss the last 4 learning objectives. We'll start with learning objective 6. We'll discuss here what gaps say about employee stock options and why the accounting treatment has been controversial. We have discussed in prior lectures stock options offered to employees. So why do companies use stock options to augment cash compensation? Well, there are several reasons. The first one is that options help align employees' interest with the interest of the owners or the stockholders. Second is that there are many startup companies that could be considered high growth but cash poor. And so they can't afford to pay more attractive cash salaries to their executives. And so giving these executive stock options make these new startup companies more attractive. Another reason is that stock options can actually provide tax savings to the employee or the employer. A typical employee stock option gives the employee the right to purchase a specified number of common shares or stocks at a specified price called the exercise price within specified time period. The current GAAP requirements for share-based compensation includes, firstly, that companies must record the cost of the employee services received in exchange for a stock option award. Second, this compensation cost must be determined by the award's grant date fair value. This is measured using option pricing models adjusted for the unique characteristics of the employee stock options. Now, this grant date fair value is actually quite controversial because GAAP says that an observable market price must be the starting point for determining the fair value of employee stock options. The problem is that a market price is rarely, if ever, available. Why? Because employee stock options are not traded on an organized exchange. So when a market price is not available, then GAAP says that the fair value is to be determined using an option pricing model, but it does not specify which particular model. Many are using the Black-Scholes model, and there are controversy around the use of Black-Scholes model as well. Why is that? Because the formula doesn't consider the added restrictions of employee options, such as the vesting and the lack of transferability. So let's look at this third requirement. The grant date compensation cost must also be recognized, and it must be expensed using a straight line basis over the vesting period. You'll see what the vesting period like when we go to the example. Now, the fourth requirement is that the incremental compensation cost arising from the modifications to the original award terms must be recognized also during the vesting period. However, changes in the fair value of the original options award itself are not recognized. So let us have a look at an example. Equity-Ten grants 6,000 common stock options to each of its top 5 managers on January 1st, 20x1. That date, both the exercise price of the options and the market price of Equity-Ten stock are $30. So you notice that this price includes both the market price and the option. Now, to provide managers an incentive to remain at Equity-Ten, the options cannot be exercised before January 1st, 20x4. This time span between the grant date on January 1st, 20x1 and the first available exercise date, January 1st, 20x4, is called the vesting period. Now, guidance options do not expire until January 1st, 20y1, giving the options a 10-year legal life. But GAAP requires that we estimate the expected life of the options, meaning we must forecast when employees are likely to exercise the options. So the factors to consider in estimating the expected life would include the average length of time similar grants have remained outstanding in the past and the expected volatility of the company's common stock price. So guidance options have an expected life in this example of 5 years. The fair value, as what I mentioned earlier, of the stock options must be measured at grant date. That is the date when both the grant's terms are set and the stock options are awarded to individual employees. So, assuming that each option has a fair value of $10.05 at the grant date. So in your textbook, the calculation for the $10.05 fair value is provided, but we will not go through that in detail. So using the fair value of $10.05, the total compensation cost of all employee stock option awards is $301,500. That is 30,000 options, which is 6,000 common stock options awarded to 5 managers. So that is 30,000 options times the fair value of $10.05. So that's $301,500. Now, it says here that Guyton would recognize $100,500, that is $301,500 divided by 3, as the compensation in each of the years from 20x1 through to 20x3, because that's the vesting period, 3 years. So, the journal entry every year from 20x1 to 20x3 would be to debit compensation expense $100,500 and credit paid in capital stock options $100,500. Now, how do we account at that date when the managers exercise the option? Let's say that Guyton's share price rises to $42 by December 31st, 20x5. And all the managers exercise their options on that date. For financial reporting purposes, note that $42 is irrelevant. The $301,500 that is related to the option fair value at the date of the grant was fully accrued by 31st December 20x3. Therefore, the entry to record the exercise of the employee stock options would be, we'll debit cash 30,000 options times $30. That's the exercise price, $900,000 in cash. We will also debit here paid in capital stock options. We have recorded 3 years of $100,500, so the full amount of $301,500 will now be debited. We'll credit the common stock par at $20 times 30,000. So that would give us $600,000. And we'll also credit now paid in capital in excess of par. And this is going to be the difference between the amount of cash we received, $900,000, plus the paid in capital stock options of $301,500 minus the common stock par value of $600,000. So we'll credit paid in capital in excess of par for $601,500. Now let's move on to learning objective 7. Here we'll understand how GAAP accounts for tax benefits that are associated with employee stock options. From the point of view of the employees are not taxed until they sell their stocks. But that's only if they qualify for these incentive stock options. So to qualify for these incentive stock options, or ISO, an option must meet many criteria for the ISO to kick in. First one is that the option is granted within 10 years from the date that the plan is adopted. Second, the option cannot be exercised after 10 years from the date of the grant. Third, the exercise price can't be less than the fair value of the stock at the grant date. The option also must not be transferable. And at the time of the grant, the employee does not own more than 10% of the voting stock of the employer. Now, if all those criteria were met, there's one more thing. ISO treatment is limited to options where the aggregate value of the underlying stock is 100,000 or less. So there is a cap. So how is this applied? Let's go back to the example of Guyton Corporation. Recall that the options were exercisable on January 1st, 20x4. So the limit would apply to 20x4. Each manager received 6,000 shares of stock, but not all of the options would qualify as ISOs because of the $100,000 limit. So we'll divide $100,000 by the $30 stock price at the date of the grant. And so we will get 3,333 shares that qualify. So the remaining 2,667 shares will be treated as non-qualified options, even if they have met the other 5 criteria that I mentioned earlier. So at the date of exercise, the managers would not owe any personal tax on the 3,333 shares that are considered ISOs, even though the stock price exceeds the exercise price by $12. So what happens with those that do not qualify with ISO? Well, for non-qualified plans, employees will owe tax on the intrinsic value at the date of the exercise. So let's go back to the Guyton example. The managers would increase their 20x5, the year of exercise, taxable income by $32,004. This is the $12 intrinsic value at exercise date multiplied by the 2,667 non-qualified shares. So the employees still owe this tax, though the value of the purchased stock may have fallen substantially by the time the tax is due. Now let's look at how does tax accounting interact with financial reporting. So this is from the employer's point of view. Stock compensation expense is based on the fair value of the stock options at the date of grant. So as the firm recognizes compensation expense on the income statement, it also recognizes an expected tax benefit based on that compensation expense. For an ISO, the employer does not receive a tax deduction, and so no tax benefit is recognized despite having to recognize the expense for GAAP purposes. So this will represent the permanent difference because the compensation will be deducted in determining the GAAP pre-tax income, but it will not be deducted in determining taxable income. The accounting for non-qualified options, on the other hand, is a bit more complicated because the employer expects to receive a tax deduction in future period. So the difference between the GAAP pre-tax income and the tax return taxable income is referred to as temporary difference because the difference relates to the timing of expense recognition, not the amount of the expense. All right, let's now move to learning objective 8. This is where we will learn how GAAP and IFRS account for convertible debts. Remember, in part A of the lecture, we talked about preferred stocks as the type of stock that has features of debt and equity. So here is another one, convertible debt. These bond contracts allow the investor to exchange the debt for stock at some future date. So here's an example. Hooker Inc. issues $400 million of convertible notes at par at a time when its common shares were trading at $20 per share. These notes pay a stated interest rate of 4% annually, mature in 5 years, and can be exchanged at any time for Hooker Inc. stock at a conversion price of $22.68 per common share. So upon conversion, Hooker must issue shares and cannot exchange the notes for cash. Because the notes are issued in units of $1,000 face value, the conversion price means that investors can exchange each note for slightly more than 44 shares of stock. So that's just the $1,000 face value divided by the share price of $22.68. Hooker's non-convertible debt borrowing rate is 10% per year. Consequently, the discounted present value of the note is $772.55. The calculation of this is shown in the parentheses there. $1,000 face value is multiplied by the present value factor at 10% at the end of 5 years, and that's 0.62092, plus the $40 interest payment because the bond has been issued for 4% annually. So 4 times 1,000 is $40 interest payment, and this will be multiplied by the present value of an annuity at the end of 5 years at 10% discount rate. So that is 3.79079. So given the discounted present value of the note, $772.55, that means the investors are willing to pay $227.45 more than the present value of each Hooker note because of the conversion feature attached to the debt, because they are buying at face value $1,000, right? But the discounted present value is only $772.55. This means that the investors are willing to pay $227.45 more than the present value of each Hooker note. Why? Because of the conversion feature attached to the debt. Now let us consider the convertible debt financial reporting issues. Now the conversion price, which is the dollar value at which the debt can be converted into common stock, is typically higher than the prevailing market price of the company's common shares when the debt is issued. Convertible notes and bonds are also usually callable or redeemable by the issuer at a specified price before maturity. So it is clear that convertible debt is a common form of borrowing. GAAP specifies that convertible bonds must be recorded as debt only, with no value assigned to the option privilege. Remember, the option privilege in the Hooker example is worth $227.45, but it says here no value is assigned to the option privilege. So the entries would be to debit cash for $400 million and credit convertible subordinated debentures for the same amount. Then we will also be debiting interest expense and crediting cash for $16 million, the 4% interest. All right. Let's now look at the accounting issues upon conversion of convertible debt. So let's suppose that some, but not all investors have chosen to exercise their conversion privilege by exchanging 100 million of their notes. Furthermore, the company's stock has a current market value of $25 per share, which is above the $22.68 conversion price. So this means that the investors will surrender notes with a face value and a book value of $100 million in exchange for common stock with a market value of about $110 million, representing the increase in the market value of the shares. So GAAP permits companies to record debt conversions in two ways. Let's look at the first method. The book value method will record the newly issued stock at the book value of the debt retired. So here, the journal entry would be to debit convertible subordinated debentures for $100 million and credit common stock. At $1 par value, the value of the stocks would be $4,400,000. Remember that each $1,000 note can be exchanged with 44 shares. All right, so 1,000 divided by 2268 is 44 shares. Now that only $100 million worth of notes are converted to stocks, this will actually be tantamount to 4,400,000 shares. All right, at $1 par value, we'll credit common stock for $4,400,000 and will also credit paid in capital in excess of par for the difference. So that's $95.6 million. If we use the market value method, we'll record the newly issued shares at their current market value. Any difference between the $25 market value and the $22.68 conversion price is recorded as a loss or gain on conversion. So the journal entry would be to debit convertible subordinated debentures for $100 million, debit loss on debt conversion for $10 million, and credit common stock $1 par $4.4 million, and also credit paid in capital in excess of par for $105.6 million. Note that the loss on debt conversion of $10 million is gathered from this figure. We have shown here that the stock market value is about $110 million. That was rounded. Let's now consider some analytical insights that we can get from convertible debt. Now, estimating the future cash flow implications of convertible debt is difficult. This is because it's necessary to consider both the scheduled interest and the principal payments for the debt, as well as the likelihood of the conversion prior to maturity. Now, option pricing methods can be used to evaluate the probability of conversion over long time intervals. But for short-term projections, a simple comparison of the conversion price with the current market price may actually prove informative. If the options are considered underwater, this means that the exercise price is greater than the current share price, and if it's underwater and it's close to expiration, then it is unlikely to be exercised. Another insight that we can get from convertible debt is that recorded interest expense may seriously understate the true cost of debt financing for companies that issue convertible bonds or notes. Let's go back to the Hooker example. Recall that Hooker's debt was issued at 4% cost. Now, it's unlikely that Hooker is as creditworthy or close to being creditworthy as the US government. Yet, the company's cost is only 0.5% higher than what investors are charging the government at 3.5% annual interest for loans from the federal government. So by ignoring the value of conversion features, current GAAP understates interest expense. The appearance of zero coupon, zero yield convertible debt also underscores the inherent deficiencies of GAAP requirements. Let's have a look at this example. In April 20X1, Skagit sold $750 million of zero coupon convertible notes and received proceeds equal to the notes, $750 million face value. The notes mature in 20X6 and can be converted into shares of Skagit common stock at the note holder's option. Note that zero coupon notes do not require the borrower, in this case Skagit, to make periodic interest payments over the life of the loan. And because the Skagit notes were issued at par, Skagit received cash equal to the $750 million face value. There's no discount to amortize over the life of the loan. No periodic coupon interest and no discount amortization mean no interest expense gets recorded. In short, Skagit will not recognize any interest expense on the loan even though the notes may never be converted into shares of common stock. So it's almost like free loan. So the lesson for corporate manager is clear. Current GAAP allows you to avoid interest expense as long as you issue zero coupon convertible debt and structure the conversion features so that the debt sells for par value. What is the lesson for analysts here? Interest expense sometimes can seriously understate a company's true cost of debt. All right, let us have a look at another type of convertible debt, this time a debt that can be settled in cash instead of shares. So there is a GAAP exception for convertible debt where the borrower has the right upon conversion to pay some or all of the conversion value in cash rather than in shares. So in this special case, GAAP requires separate recognition of the debt and the equity components. The initial carrying value of the debt component is measured as the fair value of a similar liability that does not possess the conversion feature. Another thing to remember here is that the carrying value of the equity component is measured by deducting this liability fair value from the proceeds received when the convertible debt was issued. And in subsequent years, accounting for the convertible notes adheres to the effective interest method. So let's look at this example. Lebeda Corporation issues on January 1st, 20XO, convertible notes with an aggregate face value of $100 million and a 2% nominal interest rate. The notes mature in 10 years and interest payments occur annually on December 31st. In other words, the notes specify promised cash flow payments to investors of $2 million in December of each year plus the $100 million principal in December of 20X9. The notes are convertible into 1 million shares and if exercised, Lebeda can either deliver shares or pay cash equal to the settlement market value of the shares. So if investors were to exercise the conversion feature at a time when Lebida's share price was 115, management would either hand over the 1 million shares or pay $115 million in cash. Finally, the notes are assumed to be issued at par, meaning that Lebida received $100 million cash from investors. Without the conversion feature, investors would have priced the notes to yield an 8% effective return that properly reflects Lebida's credit risk. In this case, Lebida would have raised only $59,739,160, which is as shown in the calculation there, at the discount rate of 8% effective return. So the journal entry to record this convertible debt on January 1st, 20XO would be to debit cash $100 million, debit also discount on convertible notes, the difference between $100 million and the amount that we have calculated here, the $59,739,160. So that is $40,260,840. And our credit would be to convertible notes payable $100 million, and credit also shareholders' equity conversion option for the discount, $40,260,840. And in subsequent years, Lebida will be making this journal entry starting from December 31st, 20XO. They will be debiting interest expense of $4,779,133. How did we get that? So that $59,739,160 value of this debt multiplied by the 8% rate credit, $2 million, representing the interest payment, and discount on convertible notes will also be credited for the difference. So as our global vantage point, we'll look at how GAAP and IFRS guidelines differ in terms of convertible debts. Unlike US GAAP, IFRS guidelines for convertible debt require the liability and equity components to be separated. So this approach recognizes that when a company issues convertible debt, it is really issuing two distinct types of securities. The debt that may be in the form of a bond or a note, this represents the balance sheet liability, and the option to convert that debt into shares of stock, and that's the shareholders' equity portion. So even though investors pay just one price for the combined financial instrument, they are really getting two securities, and therefore it must be recorded separately when the company issues convertible debt. So now we'll move to the last learning objective, and this is where we will revisit the calculation and interpretation of basic earnings per share, EPS, as well as diluted EPS. The amount of income and cash flow that a company is expected to generate is a major determinant of the company's value. EPS shows how much of the company's total earnings accrue to each individual shares of stock. EPS is a straightforward calculation when the company has a simple capital structure. So what do we mean by simple? A simple capital structure exists when a company has no convertible securities and no stock options or warrants outstanding. The basic EPS is simply net income minus the preferred dividends and dividing it by the weighted average number of common shares outstanding. So let us have a look at the example here. We have total stockholders' equity on January 1st amounting to $14,260,000, and at the end of the year, December 31st, $19 million. Note too that on January 1st, we have 160,000 shares issued and outstanding, but by the end of December, we have 200,000 shares issued and outstanding. We are also provided some additional information here. The 40,000 additional common shares were issued on September 1st and thus were outstanding for the last third of the year. The details of retained earnings is also provided here. The specific calculation of the weighted average number of outstanding shares would be 160,000 is the number of shares outstanding from January 1st to August 31st. So that will have a weighting of 2/3 because that's 2/3 of the year. And so that would give us 106,667. From September 1st to December 31st, we already have 200,000 outstanding shares, and that is only for a third of the year. So we'll multiply 1/3 by 200,000 and we'll get 66,667. So our weighted average shares is 173,334. Solomon Corporation's basic EPS for the year 20X1 therefore would be calculated as follows. The net income 1,257,331 as given there, minus the preferred dividends of 70,000. That will constitute our numerator for EPS calculation. And our weighted average common shares of 173,334 will be the denominator. So that gives us $6.85. That's basic EPS. Now, let us consider a complex capital structure. This occurs when a firm has financing that includes either securities that are convertible into common stock or options and warrants that entitle holders to obtain common stock under specified conditions. So this possible increase in the number of shares is called potential dilution. Diluted EPS, therefore, is calculated as your basic numerator, that is your net income minus the preferred dividends, plus income adjustments due to dilutive financial instruments, divided by basic number of common shares outstanding, plus newly issuable shares due to dilutive financial instruments. So let's have a look at this example. At January 1st, 20X1, Solomon also had the following financial instruments outstanding. $1 million of 5% convertible debenture bonds due in 15 years, which were sold at par, that is $1,000 per bond. Each $1,000 bond pays interest of $50 per year and is convertible into 10 shares of common stock. So how do we calculate the diluted EPS here? If we use the if converted method, the convertible debentures are included in diluted EPS by assuming conversion on the first day of the reporting period. So the after-tax effect of interest payments on the debt will be added back in the EPS numerator. So how did we get that 39,500? It's simply the $50 times $1,000 bond. That will give us $50,000 multiplied by 1 minus the tax rate, because it's the after-tax effect of interest payments that we are after. So we'll multiply 50,000 by 0.79. That's 1 minus the tax rate. All right, and we'll get 39,500. We'll add that to the numerator. Then the additional shares that would be issued on conversion will be added to the denominator. So how did we get the 10,000 shares there? It actually says here that each $1,000 bond converts into 10 shares. So 1 million divided by 1,000 times 10 would give us 10,000 shares. All right, so in this case, the calculated diluted EPS would be $6.69 per share. Let's continue on with this EPS illustration. In addition, at January 1st, 20X1, Solomon had the following financial instrument outstanding. They have options to buy 20,000 shares of common stock at $100 per share. These options were issued to former owners of an acquired company on February 9, 20XO and expires on February 9, 20X2. Stock options are dilutive when they are in the money, and that means when the average market price, in this example $114, exceeds the option exercise price, which in this case is $100. Here, we will use the Treasury stock method. We assume that the $2 million proceeds to the company from the presumptive exercise of the options, which is 20,000 shares at $100 per share, are used to repurchase previously issued common shares at the $114 average market price that existed during the year. The cash from the options is sufficient to acquire 17,544 shares. How did we get that? $2 million divided by $114 per share. So because 20,000 shares are presumed issued and only 17,544 are presumed acquired, the difference of 2,456 net new common shares will have to be added to the prior diluted denominator. So the calculation of diluted EPS will now be, numerator will still be the same, but we will have to add another 2,456 in the denominator. This would give us $6.60 per share. Let us examine further this Treasury stock method and the stock compensation. The current stock option accounting also impacts the denominator in the diluted calculation because the average unamortized stock compensation expense associated with the stock options is viewed as proceeds under the Treasury stock method. So to illustrate this, let's refer back to the Guyton example earlier. Let's assume that the average stock price in 20X2 is $36. The presumed shares to be added to the diluted denominator under the Treasury stock method would be calculated as follows. So the number of options outstanding was 30,000. And remember that the exercise option was for $30. So 30,000 times $30 is 900,000. Now, we also need to calculate here the average unamortized stock compensation for 20X2. So the average is the beginning balance of 201,000 plus the ending balance of 100,500 divided by 2. And that would give us 150,750. So we'll add this back to the proceeds from the exercise of options, 900,000, and this will give us total proceeds of 1,050,750. Then we will divide this by the average share price of $36, and this will give us 29,188. This is the Treasury shares presumed to be purchased. So if we deduct this from the number of options outstanding, 30,000 minus the Treasury shares, 29,188, the presumed new shares issued will have to be 812. Recall that the options can only affect the denominator in diluted EPS. So this 812 will have to be added to the denominator. If you ever encounter this term anti-dilutive, it's important to note what it means. A security is anti-dilutive when its assumed conversion or exercise increases the EPS. Now, such securities are ignored when calculating diluted EPS. So the options would have been anti-dilutive if the average market price had been less than the exercise price. The treasury stock method would have resulted in a negative number of net new shares, thereby decreasing the denominator and increasing EPS. Having calculated the basic and diluted EPS, the question now is EPS a meaningful number? EPS ignores the amount of capital required to generate reported earnings. Have a look at these two companies, A and B. Which of the two firms performed best? Well, both companies recorded the same basic EPS of $10 because they have the same net income, 1 million, and weighted average common shares outstanding, both 100,000. However, Company B needed twice as much equity capital and 50% more gross assets to attain the $1 million net income. Even though both A and B report the same level of net income and EPS, B has an ROE of only 5% while A has 10% return on equity. And finally, Company A generates more earnings from existing resources, that is, from its equity capital of 10 million. All right, let us apply what we have learned in exercise 16-5. Warren Corporation that was organized on January 1st, 20X1 with an authorization of common stock at $5 par value per share. What would be the balance in the additional paid-in capital at the end of the year is what we are required to do. January 20X1 will record 100,000 shares issued. That would give us cash of 500,000 and common stock at par of 500,000. On the 6th of April, we issued 50,000 shares at $7. So we will get cash of 50,000 times 7. That's 350,000. At par will be $5 times 50,000. So that's 250,000. And the additional paid-in capital will be the difference, $2 times 50,000. So that's 100,000. On the 8th of June, we issued another 15,000 shares at $10 per share. 15,000 times the par value of $5 will be common stock par, and the difference between the issue price of $10 and par value $5 multiplied by 15,000, so that would be credited to additional paid-in capital 75,000 for a total of 150,000. Then on July 28, we purchased 25,000 shares at $4 per share. 25,000 shares at $4 will give us 100,000. So we will be crediting cash 100,000 and we will be debiting treasury stock for 100,000. This will be a reduction in the equity. That's why it is negative. And finally, on the 31st of December, we sold 25,000 shares in treasury at $8 per share. 25,000 times 8, 200,000. So we'll be debiting cash and we will credit treasury stock, thereby reducing our treasury stock to zero. And the remaining 100,000 will go to additional paid-in capital. So therefore, as at 31st of December 20X1, we would have $1.1 million in cash. Par value of common stock is 825,000 and our additional paid-in capital would be 275,000. All right. Let us move on to the next exercise, 16-16. On July 1st, 20X1, Amos Corporation granted non-transferable, non-qualified stock options to certain key employees as additional compensation. The options permit the purchase of 20,000 shares of Amos $1 par common stock at a price of $32 per share. On the grant date, the stock market's value was $32 per share. The options were exercisable beginning July 1st, 20x5 and expire on July 1st, 20x9. On February 3, 20x7, when the stock was selling for $53 per share, all options were exercised. Amos' tax rate is 21% and a December 31st year-end for financial reporting purposes. So the first requirement asks us how much compensation expense should Amos record in 20x1 and 20x2 if the options are worth $15 per share on the grant date. The total compensation cost is $15 multiplied by 20,000 share options. So that will give us 300,000, and then we'll divide this by the vesting period in years. So the grant date was 1st of July 20x1 and it's exercisable beginning 1st July 20x5. So there are 4 years vesting period. So we'll divide it by 4 and we'll get the annual cost of 75,000. So in 20x1, we will be multiplying this by half a year because the grant date was on 1st of July 20x1 and the fiscal year runs from 1st January to December 31. In 20x2, then the full annual cost will be recognized as part of the compensation expense. Let's go to number 2. Compute the tax benefit that Amos will receive in 20x7 when the employees exercise the options. It says on February 3rd, 20x7 is when the stock was selling at 53 per share and all options were exercised. The tax benefit will be in 20x7. The stock price at the date of exercise is $53 minus the exercise price of $32 will give the intrinsic value of $21. When we multiply this by the number of options, 20,000, the amount that is tax deductible will therefore be $420,000. And so we'll multiply 420,000 by 21% to give us the tax benefit in 20x7 of $88,200. All right, let's move on to problem 16-1. Keystone Enterprises just announced record 20x1 EPS of $5. This is the 10th consecutive year that the company has increased its EPS. Unfortunately, management fears that this string of EPS increases is about to be broken. Keystone is forecasting net income for 20x2 and 20x3 at $10 million each year, at the same level earned in 20x1. The company has 2 million shares of common stock outstanding, no preferred stock, and no convertible debt. How many common shares does Keystone need to buy back at the beginning of 20x2 and 20x3 to maintain the EPS growth of 25 cents per share each year? Now, to answer this question, it would depend on when during the year the shares are repurchased. The most straightforward calculation would assume that shares are repurchased at the beginning of the year. The target 20x2 EPS is $5.25 and income is 10 million. So if we divide 10 million by 525, you would get 1,904,762. That should be the shares outstanding. Currently, the company has 2 million shares. So if we deduct 1,904,762 from the 2 million shares that the company has, that means they must buy back 95,238 shares in order for them to increase their EPS from $5 to $5.25 in 20x2. In 20x3, they wanted another 25 cents of EPS added to 20x2 EPS of 525. So they are targeting 550 EPS. So divide $10 million by 550, 1,818,182 shares. This means they need to repurchase another 86,580 shares at the beginning of 20x3. So both share estimates assume that the cash used to buy back the shares will not itself affect the income. Otherwise, additional shares will need to be repurchased to offset the earnings decline from interest expense, for example, if the cash is borrowed. But in requirement 1, it's actually stated, note, Keystone will use excess cash from operations to pay for the stock. So that means they don't need to borrow from the bank to buy back the shares. Let's move on to requirement 2. Explain why your answer to requirement 1 would change if the buybacks were to occur in the middle of each year. If the buybacks occur mid-year, Keystone would then need to double the number of repurchased shares. The reason for this is that each share would receive a 50% weight in the EPS calculation. Let's go to number 3. Why do you think Keystone's management would be concerned about maintaining the company's record of EPS growth? Well, as we have already discussed, there are several reasons why the management might want to maintain the company's record of earnings growth. For one thing, management compensation and loan agreements may be tied to these specific earnings targets or growth levels. And another possible reason would be that they wanted to maintain credibility with analysts and investors by delivering earnings consistent with management forecasts. All right, well, we have covered quite a lot in topic 8, but I'd like to end with this quote from Billy Graham. He said, "We can possess nothing, no property, and no person. It is God who owns everything, and we are but stewards of his property during the brief time we are on earth." This quote puts everything into perspective, that God is the owner of everything, and him only should we trust. As the Apostle Paul said in 2 Timothy chapter 1 verse 12, he said, "I know whom I have believed, and am convinced that he, God, is able to guard what I have entrusted to him until that day." Let us pray. Our gracious Father in heaven, we are so grateful that you own everything and you love us so much. Thank you, dear Lord, for being our God who wants what is best for each one of us. We pray that we will always trust you and surrender all to you. May the Holy Spirit continue to be with each one of us. In Jesus' name we pray. Amen. Don't forget to do your post-lecture required activities, and I will see you in class soon. Bye for now.